I'm Dale Corpus, the Senior Transition Specialist and Real Estate Expert based in the San Francisco Bay Area, and I'm also part of the sandwich generation myself. One of the biggest questions I hear from families across the Bay Area is, how do we afford senior care without draining everything mom or dad works so hard for? I remember speaking with a family in San Mateo who had just moved their father into assisted living. They were shocked when their CPA told them they could deduct part of the entrance fee and ongoing monthly fees as medical expenses. It saved them thousands of dollars in that first year, money that allowed them to pay for additional caregiving support and reduce the financial stress on the adult children. The truth is, most families don't know these strategies exist, and too often they miss out simply because no one told them. That's why I'm so excited about today's episode. I'm joined by Chris Torres, a CPA with over 20 years of experience who runs Urban Abrahamson and Company, a firm that's been serving families in Palo Alto since 1965. Chris specializes in helping seniors and their families uncover tax strategies that aren't commonly talked about. Things like how to leverage large medical deductions during a senior move, how to time Roth conversions, and other planning moves that can literally save thousands. If you're part of the sandwich generation, caring for aging parents, or planning your own transition into senior living, this episode could change how you think about taxes and care planning. Let's dive in.
Welcome to the Simplify Senior Transitions podcast, where we help families navigate senior living, real estate, and everything in between. Hosted by Senior Transition Specialist Dale Corpus, this show brings you expert insights, real solutions, and stress-free strategies to make senior transitions simple. Ready to dive in? Let's go.
And we're back, everybody. Chris, welcome to the podcast. How are you?
Good, Dale. And yourself?
I'm doing great. Let's jump right in. Can you start by sharing how you got into tax work and what drew you to continue your father's CPA legacy?
Okay, great question. Well, I got started early at a young age. My dad has been at this firm since 1983, and he used to put me to work when I was maybe elementary, middle school. And I would do filing, move heavy office furniture around, and do all kinds of things like that, stamp letters using the postage meter and so forth. And so my dad put me to work so I could earn maybe a few bucks.
Yeah.
And so he always stressed, since we were very young, that we should start saving for retirement early.
Yeah.
So with that money that I earned, working for him, doing odds and ends kind of thing, we started a Roth IRA. And so I got started with my Roth IRA probably at an early age before I could legally work full time or 40 hours a week. So early on, my dad just stressed the importance of saving for retirement, starting as early as possible and letting the power of compounding do the rest of the heavy lifting for you. And so I went to college at UC Davis, and my original major was computer engineering. The time I graduated was the time of the dot-com boom bubble burst. So shortly after I started working, I was out of a job. And at that point, my dad said, well, since you're looking for a job, why don't you just study accounting and see how you like it? So I did start studying accounting and so forth, and I grew a liking to it. And I appreciated the stability of the accounting and tax business because in growing up, my dad has always been a CPA since he was in the Philippines, and he never was out of a job ever his entire life. So I took the leap of faith and studied accounting and learned it, and also applied with the California Board of Accountancy to sit for the CPA exam. And I said, I don't ever want to be laid off again. So yeah, I think I'm going to make that leap and get into the tax business. After all, my other two brothers weren't into the tax business, and my dad is one to think of legacies and so forth. So naturally, he kind of wanted someone to work with that he could pass it on to. And so we have two different personalities, but we get along quite well. So people often ask me, how do you get along working with your dad? I could never do that. I'll tell you, in the 20 plus years I work with him, it's been fantastic. I've learned a lot from the best, and I hope to continue this on for many years to come.
I love it. I love it. This is in your DNA. Now, From your perspective, why is tax planning especially important for seniors compared to other groups?
Yes, for seniors, a lot of people think when you retire, and as most seniors do, that their income will all of a sudden drop,
right,
and that they are fixed income with Social Security and so forth. But in this area, there are a lot of seniors that have accumulated quite a nest egg,
Right.
whether it's through their job, like 401ks or saving. This generation, the generation of our parents and so forth,
Yeah.
they were savers. Many of the seniors that I've talked to have actually saved a lot of money. And so it's important for them to do tax planning because with large retirement account balances, after they reach a certain age, over 72 now, they have to take required minimum distributions from 401k, IRAs, and so forth. And so some people don't realize that those required minimum distributions, or RMDs as we call them, can be quite large for these people who have saved up, well over $1 million or multiple millions of dollars. So it's important to plan and find ways to lower your tax liability in retirement. Because I've seen people who think that they will be in a lower tax bracket once they retire, but
Yep.
sometimes they end up being in a higher tax bracket because of all the money they've saved. And now they have to take it out because the government wants its taxes. So they don't let you keep the money in their retirement accounts forever. At some point, they make you start taking it out. And so it's important to properly plan around those events because this will be an ongoing problem once they've started their required minimum distributions.
Understood. I want to talk about the overlooked tax benefits of senior living. Let's start with one of the biggest hidden opportunities, the medical deduction for senior living. Can you explain how
Yes.
that works?
Yes. So a lot of folks, the seniors, as you mentioned, Dale, will eventually, when they need help in living, they can no longer live independently. They
Right.
move into a senior home. And a lot of these senior homes have huge entrance fees.
Right.
I've seen seniors pay 800,000,
Right.
well over $1 million or $2 million just to get into a senior facility. On top of that, they have large monthly fees that include rent, food,
Right.
and possibly medical care if they need it. And I've seen some seniors pay $9,000 a month or so. So usually the range I see is between on the low end, 5,000, on the high end, 9,000, 10,000 and up per month. And
Right.
so these seniors are our clients. Obviously, they're well aware of the tax deduction that they get for when they move into these senior homes. The first year in which they move into the senior home, they can deduct a percentage of the entrance fee and a percentage of the monthly fee as a medical expense. So someone might wonder, how do I figure out that percentage? A lot of times these senior homes will issue a letter to their residents that will say, in their opinion, 30% or so of the entrance fee and the monthly fee are deductible as medical expense.
Okay.
So they determine the percentage for you. And it's important for you or the seniors to have that letter so that in case they are examined by the IRS or
Yeah.
franchise tax board, that they have a backup saying, I took 30% of my entrance fee and monthly rent as medical expense because this is the letter that I got from my home. And so I've never really seen anyone audited for that, but there's always a possibility to get audited. And that is a big deduction in
Yeah.
the first year because the entrance fee alone, like I said, it could be upwards of over $1 million. So 30% of that could be $300,000 deduction.
Right.
And then every year after that, a percentage of the rent, say they pay $10,000 a month and it's 30%. So $3,000 a month times 12 months is $36,000. So that can be a big medical expense as well. And so you'd have to realize on the medical expense, you can deduct only the amounts over 7.5% of your adjusted gross income, AGI as we call it. So a lot of times seniors who pay that much in rent and entrance fee, they will cross that 7.5% AGI threshold. And so that is what we call an itemized deduction. So that includes mortgage interest, property taxes, and medical expenses, and a few others. But those are the major itemized deductions that people take advantage of.
Okay. Now, I know that on entrance fees, those are typically in retirement communities that are CCRCs, also known as the continuing care retirement communities. So for some of those big entrance fees that you're talking about in the Bay Area, just for my clarification, does a community have to have both entrance fees and monthly fees in order to be deductible, or
It's a-
or
yeah.
one or the other?
So no, as long as They are what the tax code considers qualified medical expenses. A portion, in their opinion, if a portion of your rent goes towards maybe hiring nurses that help these seniors live, make sure they take their medication or do welfare checks on them, things like that, those can be deducted. So to answer your question, Dale, the senior home does not necessarily have to have a big entrance fee to make it a qualified medical expense and to make it deductible. We have seniors who don't pay entrance, but then maybe they pay a higher monthly fee,
Right.
say $12,000 a month. And the care home can issue a letter and say maybe 32% of that is qualified medical expense.
Okay. That
They
makes
can
sense. Yeah, that makes sense because I've seen communities that don't have much of an entrance fee, but they're over 15,000 a month.
Yes, that's just a big expense that seniors and their families have to worry about once their parents get into old age and need help in caring for them.
Okay. Now, can you give us an example of how much a family might save in their first year of moving into senior living? Any
Um,
scenarios?
yes, that's a great question. Obviously, it all depends on the income
Right.
of those people. But oftentimes in the first year, if they have that big entrance fee and they have that monthly deduction for medical, the qualified medical expenses, that oftentimes wipes out all or most of the tax liability of that senior in that given year.
Yeah.
So in that year, they could have a zero tax liability once it's all said and done. And once you calculated the deduction, the itemized deductions could totally wipe out their taxable income.
Okay. Related question is, why do you think so few families know about this deduction?
All right. Obviously, all our clients are aware of it. So I
Yeah.
would say seniors and families that do work with a professional, CPA, EA, or any professional tax preparer are all aware of this deduction. But I know I've come across families where, the mom or dad has done the taxes for many, many years, and they say, oh, it's pretty simple. I just do it myself. No need for me to hire anyone. And oftentimes, those are the folks who may not be aware of this large deduction.
Right.
So it can be worth it to hire a professional to do your taxes because they can make you aware of things like this that you can take advantage of. And these are big numbers we're talking about.
Right. Especially in the Bay Area, especially Silicon Valley. Yeah.
Yeah.
Let's segue into strategic timing and Roth conversions.
Mhm.
You said timing can make all the difference. Why is the year someone moves into senior living so critical for tax planning?
Oh, yeah. A fantastic question. So as I mentioned earlier, that big tax deduction when you first move into that senior home can wipe out your entire tax liability.
Yeah.
Right. And so you don't want to waste that deduction without any corresponding income. A lot of times, if people tell us before they move into the senior home that next year I'm going to be moving into a senior home and I'm paying X amount of dollars to move into that home, then we can do a tax projection and say, hey, with this tax projection, you are not owing any taxes for 2026 or
Yeah.
whatever year it is. And so what we could do is, and then we ask them, do you have an IRA or a 401k, something like that? And we can ascertain how much money is in there. And then we can do a tax projection and tell them, hey, it looks like if you convert 100,000 of your 401k into a Roth IRA, you still won't owe any taxes because you're having this large medical deduction for going into the senior home. So we crunch the numbers and see what's the ideal sweet spot for them to the amount to convert. It depends for everyone, right? It depends on the size of the deduction and how much their account's worth, right? So we will try to keep them in the middle tax bracket and keep them out of the highest tax brackets on the federal side, which can be as high as 37.5%. So doing a Roth conversion when you're about to retire or move into the senior home, it might be a little counterintuitive. People might say, I'm getting old. Why would I want to do a conversion at this point? But it can be a powerful planning tool because once you've converted the money into Roth IRA, it grows tax-free from then on out. One critical thing is when you do a Roth conversion is don't use the money that you have converted to pay the taxes. You should have money, you to take it from out of your pocket to pay the taxes because then you'll maximize the benefit of the Roth conversion because the entire 100,000 will be in the Roth now, not 75,000 after you took out 25,000 for taxes. So you should have other money to pay those taxes and convert the entire 100,000. So then from then on out, it grows tax free.
So, what mistakes do families make by not planning ahead?
There can be missed opportunities like the missed medical deductions, not saving enough for retirement, or running out of money in old age. That's one of the biggest fears of many seniors is that people are living longer nowadays, right? And sometimes people become worried that, oh, I'm 95 years old. I didn't expect to live this long, but now I am running out of money. What can I do, right?
Yeah.
Planning ahead can help prevent things like that. And working with the proper advisors can help reassure you that you will have enough money, whether you live to 95 or 100 or more.
Now, aside from senior living fees, what other medical deductions do families often overlook?
Oh, yeah. So, what the IRS defines as qualified medical expenses are any out-of-pocket medical expenses, such as prescriptions, long-term care insurance premiums,
Okay.
any supplemental health insurance premiums that you pay in addition to what's taken out for Medicare. You know,
Yeah.
what's taken out of your Social Security for Medicare is a medical deduction too. Other things like copays when you go visit the doctor, if you have to travel somewhere for medical care, some certain travel expenses are deductible as qualified medical expenses. There are a plethora of different expenses that can be deducted as medical expenses.
Okay. How about, or how do caregiver wages or in-home care qualify?
Great question. In order for those wages or payments to be qualified medical expenses, they have to help a senior with at least 2 of the 6 daily functions of living.
Yeah.
So those 6 things are bathing, dressing, eating, transferring, toileting, and continence. So if the senior needs help with at least 2 of those 6 things, they can deduct the medical expense. Whether you pay it to an individual you find yourself, who could be a relative or so forth, or if you work through an agency to hire that person that helps the senior, those would be deductible. Now, if you work through an agency, typically you don't need to issue a 1099 because the agency is incorporated and they send you an invoice for what you need to pay, right? But if you find a relative or a friend who is going to take care of that senior, you have to often issue them a 1099 to back up that deduction.
Got it. Now, can home modifications like installing ramps or grab bars be written off as well?
Yes. Modifications to your home that are medically necessary to accommodate a diagnosed medical condition or physical activity can be deductible. The one caveat is that if it increases the value of the property of that home, then you cannot deduct that amount that it increases your property by. You can only deduct the cost that exceeds the increased value of the property. You know, often you probably won't come across that too much because grab bars and ramps don't really, as you, Dale, you're a real estate professional. I don't think that really enhances the value of your home. But if it does, you have to subtract that part out, and then you can only deduct as medical expense what's over and above that.
Moving on, can you share a success story of a family that saved big because of smart planning?
Yeah, there are many stories I could mention, but one in particular is about 23 years ago, we had this client who was nearing retirement age. He owned a big machining company in the South Bay.
Yeah.
And a big company conglomerate bought his company from him for something like $40 million.
Yeah.
And he paid taxes on that. And then after that, he was on fixed income. He had investment income from the $40 million that he sold his company for after paying taxes, and then Social Security and so forth. But he had a big IRA and IRA account combined that was worth maybe a couple $1 million.
Yeah.
We recommended to him that he do a Roth conversion and pay the taxes in that year after he retired, after that big taxable year he had when he sold his company. And so he did that, converted it to approximately $2 million. And today I know that account is worth probably 12 million or more. And it's been in a Roth IRA. So if it's worth 12 million today, and he converted it and paid the taxes at $2 million,
Right.
that $10 million is tax free. He hasn't even touched that account yet, luckily for him. And so his heirs will one day probably inherit that amount, and, they will have to empty that account over 10 years, but they won't be paying taxes on that money anymore. So he saved taxes on $10 million, which is a huge amount.
Yeah. On the flip side, have you
Mhm.
seen situations where families left money on the table because they didn't know these strategies existed?
Yeah, I touched on this a little bit earlier, but this definitely happens. Sometimes folks who are a bit maybe too frugal, people in our parents' generation are very frugal. They don't like to pay for what they don't think they need to pay for. Right? These folks that don't have the right advisors, whether it's a CPA, estate and trust attorney, a good real estate agent,
Right.
a good financial advisor, when they don't have these advisors that are pointing them out to these things that they can take advantage of, then people often leave money on the table. I think it's important for people to make sure they hire the right advisors who will work together as a team to make sure they're taking care of you, your family, and helping assure that these seniors who work so hard for their money to leave a lasting legacy for their kids, grandkids, and so forth.
Yeah. How do these tax savings ease the emotional stress on families, not just the financial stress?
Yes. Basically, one of the biggest fears of many clients is that they will live too long and run out of money. So, making good investment moves, protecting as much as you can from taxes can help your money last a lot longer and leave some for those that you care for. So when you're getting up there in age, running big expenses by your financial and tax professionals before you dive into them can also be helpful in saving money. And maybe they can be the voice of reason saying, oh, maybe you shouldn't make that splurge.
Yeah.
So just having people in your ear and advising you as to whether or not you're making sound financial decisions can be important in your life. And, that advice, even though you have to pay for it, can be worth it because it can save you money and it can help you live out your life, enjoying the life to the standards that you hope for.
Yeah, understood. Many of my listeners are part of the sandwich generation, balancing kids and aging parents. How can adult children start these tax conversations with their parents without it feeling awkward?
Right. Anyone asks me for advice on something like that, I say, first, keep in mind that you have to respect your parents' independence. You don't want to come off as someone who's just telling them what to do and not listening to what they have to say, right? That's an important thing to keep in mind as you bring up these maybe sometimes difficult conversations with your parent or your elders. So one thing that you can start with is just being aware of the assets and even liabilities, if they apply, of your parents. What real estate they own, what retirement accounts they own, what savings accounts they may have, investment accounts, and so forth. Just having an inventory of all these things can be useful. And you have to be aware of their debts, whether they're mortgages, credit cards, or anything like that. So just having maybe a personal balance sheet or helping your parents, kind of come up with a personal balance sheet can help you get a good handle on what their financial situation looks like. Also, consulting with an estate and trust attorney is very important for people, especially with the more wealth that you have. This becomes even more important because having a revocable living trust, having an updated will, aside from that, making sure the beneficiary designations on your IRA and retirement accounts are up to date is very important because we've seen people who pass away who didn't update their beneficiary designations on their retirement accounts. And then it goes to the wrong person, right? Because they didn't update it. Maybe it goes to an ex-wife or something like that, where someone forgot to update their beneficiary designation. And so something gets lost because it's not going to the person intended.
Yeah. Now, what role can siblings play in making sure everyone's on the same page financially?
Yes. Just being transparent. Usually among siblings, the parents have to choose one person that they trust, right? Whether it's you or your sibling. What's important is that all the siblings communicate together and be transparent with each other because problems arise when one sibling thinks the other one is hiding their parents' money from them. And so that opens up a can of worms. It can open up legal things, legal challenges, and so forth. So just being transparent and making sure that your parents have a revocable living trust or meet with an estate and trust attorney that will put all their wishes for their legacy in writing. There's a third party who has no interest in what your parents own. So having that important third party, that attorney, will help make everything clear when the time comes and when everything needs to go to the children and so forth.
Yeah, I like that. How early should families bring in a CPA when they're planning a senior living transition?
Yeah, I guess the earlier the better, but definitely before you make the plunge to move into a senior living facility, at least the year before or a few months before would be ideal, because sometimes people are house rich and cash poor, right? So they're, especially here in the Bay Area, they have a house that's worth several $1,000,000, but they may not have much by way of cash savings in retirement accounts and so forth. So that's a big taxable event if the seniors have to sell their house in order to get the funds to move into the senior home. So definitely they will want to consult with a CPA and a financial advisor before they put their house up for sale.
Yep.
And obviously they need to consult a realtor too when they put their house up for sale. So this whole team works together and we all talk to each other to make sure we're doing what's in the best interest for our clients, the taxpayers and the seniors.
Okay. I want to segue into broader tax planning and legacy. First question here is, beyond deductions, what big picture tax strategies should seniors and their families think about?
So for larger estates, consulting with an estate and trust attorney is extremely important. You want to avoid probate at all costs because that can be costly and it's also public. Planning ahead of someone's death to do these things, to set up a revocable living trust, things like that is very important, because when someone dies, then things have changed permanently. And so you need to plan before that event happens. And there are also vehicles that people with significant wealth can put into play while their parents are still living. For example, for folks that pass away in 2025, the estate tax exemption is about $13.9 million.
Okay.
So between a couple, two people, husband and wife, that's $27.8 million. If seniors have an estate that is approaching that amount, then they definitely will want to do some planning, because anything over that, the feds take 40%. That's the estate taxes, as we call it. And so in 2026, that amount will go up to 15 million. So 30 million for a couple, and it's indexed for inflation. So it goes up every year depending on the inflation rate. So I think especially people who with net worths in that neighborhood should really, really do a lot of planning. And if parents have children with special needs that they want those children to be taken care of after they're gone, there are also vehicles that attorneys can set up that are special needs trusts to make sure after you're gone, some of your assets will be put in a special needs trust that will take care of that child for the rest of their life. So that way you don't put the burden on their siblings or anyone else to take care. It will all be enumerated in the special needs trust. And there are also other things that special needs trust can help with. You know, if people with special needs are on government assistance of any kind, a special needs trust can be a useful planning tool to help them qualify for government assistance despite having these assets that will be taking care of them for their whole life.
Yeah. How do Roth conversions fit into legacy planning for children and grandchildren?
Oh, right. So with Roth conversions, when you take money out of a Roth IRA, it's tax-free. And so ideally, it would have been growing for many, many years tax-free. So you'll have a large gain that will never be taxable. As far as planning for children and grandchildren, non-spouse beneficiaries, nowadays under the Secure Act passed in 2020, they basically will have to empty that Roth IRA if they inherit it over 10 years by the end of the 10th year. So if they inherit $1 million Roth IRA, then they'll have 10 years to empty it. But the good thing is, as they take the money out, it's not taxable. So it will not affect their tax situation. With retirement accounts, as seniors draw money out of their retirement accounts, whether they're tax deferred accounts like IRAs and 401ks, or tax-free accounts like Roth IRAs and so forth. It's nice to have two buckets when you're retired that you're drawing from, because then you can kind of manage your income and keep it at a middle tax bracket. If your RMD keeps you in the 22% tax bracket, but you still need a little bit more money for your expenses, then you can take money out of your Roth IRA for your living expenses. And then that doesn't add to your taxable income. So you can do a lot of tax planning with that, and working with your CPA, financial advisor, can help you manage your income in retirement. And generally speaking, it's advantageous for people to keep their income rather steady over the years. You don't want a big bump in the road, a big taxable event, and pay lots of taxes one year and then pay very little taxes next year. Having the right advisors can help you plan your income and manage it a little bit as much as you can. Just having the Roth IRA is another tool to helping manage your income. And a lot of times for frugal folks like my own parents, their RMDs and Social Security are sufficient for their living needs. And so they try not to touch their Roth IRA ever. So, that goes on to people like your children, grandchildren, so forth.
How do you see tax planning as part of the larger senior transition journey alongside real estate, care planning, and legal tools like trusts?
So anyone with significant wealth should have advisors who know what they're doing. Having your estate and trust attorney, CPA, financial advisor, real estate agent, all working together towards your goals is very, very important, because with your investments in real estate, the stock market, and so forth, just having the right advisors that know all the moving parts in your situation is very important. You will talk to this financial advisor and tell them what your goal for your family legacy is. Do I want to leave my kids a lot of money, or do I want to spend it all and make sure I die, like my last check bounces when I die, some people will say. So talking with these advisors will kind of help you get to those goals, whatever they may be. Some people like to leave something for their children and grandchildren, and that's great. And others will say, no, I work hard for this. I want to enjoy it throughout my life. So having those advisors will help you get to that. And make sure your legacy goals are communicated to all of these advisors so that they all know what the end game is for you. And so that way you can rest in peace knowing that you accomplished all your goals in life.
Yeah. Solid advice. Chris, what excites you most about the future of tax planning for seniors? Are there changes or opportunities you're watching?
I've always been a person who likes to help people, especially our elders. Yeah, I think it's ingrained in our culture that we like to be helpful to our elders and that we respect our elders tremendously. My parents were immigrants who came to this country when they were in their 20s, knowing just a little bit of English, and they worked hard all their lives to accumulate what they've accumulated. They worked really hard to provide us, the children, with all these great opportunities. Thankfully, I've learned a lot from them and my colleagues about these things that we do to help preserve wealth and pass it down to the next generation. Tax laws are constantly changing, so having a CPA helps a lot because they have to know how the tax laws are changing and what planning opportunities will arise because of tax law changes. So paying for that advice, it can often be worth it because it can save you more than what you pay for for the tax bill or the hourly bill that they charge you.
If families today want to just take one first step after this episode, what should they do?
Make sure you have all the right advisors lined up and make sure there's an open channel of communication between all of them. That would be one of the most important steps to take, doing all this planning.
Okay. And finally, how can someone get a hold of you if they have a question? And what's the number one message you'd want every caregiver or adult child listening to take away from this conversation?
Okay, so how can people get a hold of me? So definitely they can give me a phone call, 650-856-6161, extension 308, or you can send me an email, Chris, CHRIS, stayrich.com. That's STAYRICH.com. And I'll be glad to help answer your questions or at least get you started on that journey for planning your retirement and making sure your family is taken care of.
Okay. And I'll include any contact information in the show notes as well. Okay. And how about the other part of the question?
It's never too early to start planning, or it's never too late also to start planning. You should start planning as soon as it becomes top of mind, and don't procrastinate. Learn as much as you can from those in the business, all those advisors. Keep open lines of communication with your parents, siblings, and other family, and just make sure everyone that you care for knows what's going on, because nothing is worse than someone passing away and their intents are not made clear.
Yeah.
And then the people who have to take care of your affairs are left guessing and kind of picking up the pieces because you didn't give explicit instructions on how you wanted things to be dispersed.
Yeah. Those are wise words. Thank you so much, Chris. Thank you so much for sharing your expertise today. This conversation shows that smart tax planning isn't just about saving money. It's about giving families peace of mind and the freedom to make better care decisions for their loved ones. And for those of you watching or listening, if your loved one is considering senior living and you need to figure out what to do with their home, let's talk. Schedule a free consultation and learn more about my services at www.simplifyseniortransitions.com or DM me anytime on Instagram at soldbydale. And don't forget, my podcast, Simplify Senior Transitions, has even more conversations like this. You can find it on YouTube, Spotify, Apple Podcasts, and more. If you found this episode helpful, please hit like, subscribe, and share it with someone who needs this information. Thanks for tuning in. Chris, one last thank you for being on the show with me today.
It was a pleasure, Dale. Thank you.
You're very welcome. And for everyone else, I'll see you on the next episode of the Simplify Senior Transitions podcast.